Peter, what's your reaction to what we've heard so far? And what do you expect to hear from Mary Daly?
Well, Daly's important because she's also a voting member. And there's one thing about Powell is he likes consensus. So now we've heard from Bostic, we've heard from Waller. I'm assuming Bowman is a hawk. Powell spoke. So I find it hard to believe that Daly is going to deviate that much from what they have said. Now, also, June's far off. So there's no reason to commit right now to what you want to do in June. So I think she's going to remain very non-committal with respect to her commentary.
Victoria, let me ask you something that we haven't really discussed. What if rate cuts aren't all that important? Do stocks benefit more from a healthy economy than they do looser policy? Is that being sort of forgotten in today's trade?
A little bit, yeah. And we're going to hit earnings. I think JP Morgan kicks us off, next Friday when financials really get us into Q2. And if the focus is on earnings and we have solid economic growth and we have earnings growth and we can see then, profit expectations rise throughout the year, then absolutely stocks can overcome any cuts or lack thereof.
Right.
And it has been more of a focus recently. Right now we're in a dead period. Nobody's really reporting. So everything's on economic data. And so it's very, very heightened. Obviously, all eyes on unemployment Friday. And it's a little bit of potentially bad news is good news. If we have some bad unemployment stats, potentially that balances out sticky PCE. And I do think they will be data dependent. Everybody get their Fed bingo cards out, data dependent, patient, weigh the pros and cons. I think we're not going to see a huge policy shift unless we really get continued acceleration of inflation. And that deflationary goods trend is one that I'm watching. We've seen that really, really help with inflation, but now we've got commodities on the rise. So we got to make sure we're kind of watching the good side. But I like that. ISM, PMI, in expansionary territory, China data wasn't horrible. Some of that stuff there was a lot to like on the economic front for stocks that are in the business of selling things.
Right. And even on the earnings front, I mean, it was the Magnificent Seven that carried the broader markets all of last year. But we've certainly seen more breadth this year. I saw a chart that showed that the S&P 500 X the Magnificent Seven is actually, we're looking for better earnings out of them than the biggest mega caps themselves. What does that mean for the rally?
Well, sir, I think it's fantastic to broaden out. I think that was always a problem. We were so concentrated. And I think right now the Magnificent Seven is breaking up, kind of like the Beagles back in the day. It may not exist anymore when we're seeing the struggles, specifically today, with the Tesla issues, which is very much concentrated on EVs and vehicles. And so it's great. I think there's a lot of profit possibilities. I think the valuations aren't quite as stretched as everything else. I think if you look around, the value trade, the cyclical trade, energy, industrials, financials, those are working a little bit. We always have risks that could pop up. Will CRE come back into play? Will regional banks be an issue? Will we suddenly care about the debt levels? None of that has mattered yet.
Right.
If a company can produce earnings, if the company can raise expectations, especially if the company says, hey, we think we can make a little bit more money, I think that's great. The one area I think is going to struggle, which you're seeing today, is small caps. Small caps tend to be more levered. They tend to, if they're going to have to refinance at higher rates, that's a drag on a lot of them. And that could be an issue. And you're seeing that play out with the Russell 2000 today.